Hey everyone, Paul Clark here, and I have an interest in investing in the stock market, and it's something I really enjoy talking about. I enjoy talking to other people about it, and that being said, I feel like, in my everyday life, I don't always have everybody in my circle that is interested in investing and discussing it and learning more about it. So I wanted to be able to use YouTube as a platform and other social media to kind of reach out and engage with people, share my perspective, and learn from others and things of that nature. So that's what I'm looking at doing in this video and future videos to come. So any questions about this topic I'm going to be discussing, or anything you'd like to see discussed in the future, individual stocks, topics, anything about investing in the stock market, go ahead, drop a comment, and I would love to make a video about it. Love to connect with you. But in this video, I want to talk about getting the valuation right. Or let's say you're investing in a stock that's recently IPO'd, or it's been really hot lately, and you might be wondering, hey, is it too late for me to invest in this stock, or is the timing right? Now, one of my big positions about investing, and it's something I really, believe quite strongly, is that generally speaking, you really can't time the market, or you're not going to have a lot of success doing it. And in fact, you might drive yourself nuts trying to time the market. And when I say time the market, trying to figure out what the bottom is, what the top is, you're usually going to be wrong about those things, and those things can be pretty costly. Now, I think the most recent example, as I'm filming this video in August 2020, but coming off of the stock market meltdown, and then, of course, the miraculous recovery that we had, I think that really shows, a lack of ability to time the markets. Because, you look at everybody that was all the talking heads kind of in the investing world, a lot of them were talking about the stock market really not having a chance to recover all the losses that were taking place earlier this year. And of course, like where the bottom was, or at least the bottom up until this point, was in March. And as it stands today, the market in general has essentially recovered back to where it was before the pandemic struck. Okay, so that right there, I myself would have been included if you would have asked my opinion as the stock market started to increase, when you were looking at the unemployment numbers and you're looking at all the uncertainty with the economy. I certainly would not have been excessively bullish, and that position would have been wrong, okay? And there are numerous times throughout history where, you could have thought, oh, all the arrows, everything else is pointing towards a certain direction, and the market just doesn't cooperate, okay? So that being said, what can you do? Well, the point of this video is to try to give you a little bit more peace of mind if there's a stock you want to invest in that you think might be a little too hot. Because we just talked about it can be really difficult to time the market, and you run a really good chance of driving yourself nuts trying to get that exactly right. So let's use a specific example. So let's talk about a stock like DraftKings. Okay, so DraftKings is a stock that, you might argue that there's a lot of positive, kind of tailwinds going on for that stock. You have the online betting market is something that with, as states kind of come more online with allowing legalized U.S. gambling, you're going to see a lot more adoption of sports betting. It's something that, sports leagues have gotten behind. So you might start looking at some of those things and think, hey, is DraftKings a good investment? That being said, there's a lot of talk about them having a lofty valuation. Their market cap has been pretty aggressive lately, right? So you might be wondering, okay, if I want to invest in a stock like DraftKings, is now the time to do it? Should I wait? What's the correct approach? So I want to walk you through, kind of one way of looking at it. And the way I want to show you is with a fairly simple concept called dollar cost averaging. And with dollar cost averaging, what that's doing is it's saying, what if you invest a fixed amount every single week or month, or you pick your time period and say, no matter what happens, I'm going to put a little bit into the stock market or a little bit into a particular stock, okay? So what that allows you to do is, as the stock goes down in value, or if it goes down in value, you're able to buy more shares. If it goes up in value, you're not going to buy as much. So it kind of like equalizes or stabilizes itself as you go through kind of your investing career. So I want to walk through a scenario where you start buying a stock, and we can kind of like envision this being like a DraftKings, you start buying it at, the relative high end of the valuation. Okay? And as soon as you start putting your money in, as soon as you make that initial investment, we're going to say that the stock starts to go down in value, basically immediately and steadily. Okay, so you're going to watch that stock go from like $35 down to $34 to $33, let's say all the way down to the lower 20s, okay? And you might be wondering, what would that look like? I mean, like, surely that's not a good thing for you. Surely that's going to set you up where you're not going to be successful, or you're going to make money in investing, which of course seems a lot like success. But let's go ahead and just get into it. I've got a spreadsheet I can walk you through. I think it's going to make it a little bit more concrete about what I'm talking about, so let's get into it. Okay, so in this spreadsheet, we're going to take a look at just a hypothetical situation. Okay, so the math is going to be a little simple. We're going to assume that there's just a smooth decline. We're going to assume that there's a steady incline. But the important thing to keep in mind is we're going to assume that there's a certain stock that you're interested in, that you think is going to be a successful business and still a viable enterprise for years to come. We're going to be looking at this over a hypothetical 3 years, and we're going to assume that this stock is going to start out at $35 a share. And so again, the whole point of this video was really to kind of say, at $35 a share, is that a good price for the stock? Is that right? Does that make sense in terms of the price to earnings ratio? You look at price to sales, any valuation metrics you can possibly look at. Does that make sense? Okay. And, I want to talk about it because there's a lot of times where it's like, it's not always clear, if there's, all of the boxes are checked to say, yes, this is a good value, or yes, this is $35 and it should be trading at 50, or it should be trading at a certain price. Not always clear, a lot of variables, a lot of complexity there. So to kind of move beyond that, the point of this is to say, well, wait a minute, what if you just said, we're not going to spend our time overly focused on the valuation. We're just going to say we really like this stock. We're going to start investing in it. And, to kind of get you over the fear of what would happen if the stock, you start investing in this and it basically immediately starts to decline in value. So you like it at 35, you put some money in it. The next week you put the same amount of money in it, but it goes down, so you're able to buy more shares. But now you're looking at your broker accounts, whatever you're using, your Robinhoods, your Fidelities, and you're seeing red ink. And when you're an investor, especially if you're new and you're seeing that red ink, it doesn't feel good. It doesn't feel good to say, okay, it was at 35 and now it's at 34 and now it's at 33, and to continue to put the money in every single week when you're seeing that's not an easy thing to do. Now, I'll also add to that point that just because a stock's going down doesn't mean that that's a good investment, doesn't mean that you should continue to stick with it. You should only stick with it if the story is still intact. If there's nothing that's changed to the story and you're seeing the share price decline, then I feel like that absolutely justifies you to continue to average into the stock. If there's a big fundamental change, so let's say you're investing in DraftKings, because we were kind of talking about it as an example of kind of a high valuation stock that you might want to be investing in, that might have a successful business model but just might be a pricey stock at the moment. You might say, okay, well, what if there was a big competitor introduced? What if Amazon said that, hey, they're going to get into online gambling? Well, if the stock's going down for DraftKings in response to the Amazon news, and that is truly something that you were not aware of before, that can be, a very good reason to say, you know what, I no longer want to average into the stock. But if you're averaging into a stock, there's nothing, there's no Amazons on the horizon, there's no competitive threat you can see, you looked at it every way you can think about it, and you still like the business, I would say, hey, stick with it. So in this example, we're going to, again, talk about dollar cost averaging. We're going to say that every single week, we're just going to pick a set amount, and essentially the graph is going to look the same in terms of, the share price, of course, and it's going to really work the same on a percentage level, but your absolute dollars are going to change based on your weekly amount. But let's say every single week you want to put $100 into a stock like DraftKings. Well, okay, so if we want to do that, we can figure out every single week how many shares you can get. Now, a lot of brokerages, and I know Robinhood offers this, but you actually can buy fractional shares now. So we can do this math, in this fashion, and it would actually line up exactly like you'd be able to do it in real life with your broker if they allow fractional shares. And what we can do with that is just simply take our $100 that we want to invest every single week and say, okay, we're going to take our $100, and in the first week we're investing, it's $35, which would mean we'd be able to buy 2.85 shares. Okay. Now, the very next week, it declines by 2%, and now our $100 gets us 2.91 shares. And then it declines by another 2% and another 2%, and then eventually we're able to buy 3 shares. Eventually we're able to buy 4 shares, and it just continues to decline. But we, in this example, are just going to say we're going to continue to throw our Benjamin Franklin every single week after the stock. Now you look at the graph over here, so we see here's that 2% every single week. It's dipping down, and then eventually it bottoms, and we're going to say it goes from $35 all the way to $15.36. Now, again, when we're just talking about hypothetical situations, that doesn't sound that significant. But in reality, when you watch a stock that you like go from $35 down to $15, or you see it cut by that significant of amounts, it can really test your mettle in terms of how much you like the investment, what you want to stick with it, and all of those things. And there's a lot of people who, towards the bottom of this, start to get shaken out, and they don't get to really enjoy any of the benefits of the recovery. So, just kind of something to be aware of as you go through your investing career. But let's say, again, it bottoms, and then after that, it starts to recover, but it's recovering at a slower rate than the decline, and it's kind of set up in such a way where at the end of 3 years, it has recovered, but we're going to say that it's only recovered up to about $26. Okay? So still below our $35, pretty significantly below. So if we say 26.73 divided by, so still down, close to 25% at the end of this, right? And so the question is, would you want to invest that $100 every week into this stock, or would you rather have that $100 a week in a checking account? Okay? Just sitting there earning you that 0.001% interest or whatever ridiculous amount it is currently. That's the big question, and I want to show you what it turns out, which one is better. Because again, I think finding out which one is better, there's a couple things. I think one, intuitively, that looking at a chart like this, if I told you there was a stock that, hey, it's a really good stock, it's at $35, and you invest your money, $100 every week, and guess what? Congratulations, at the end of 3 years, it's going to be worth less than $27. Would you want to own that stock? I think a lot of people would say, nope, that's why I don't want to invest in the stock market. It's too risky. Leave it in the bank. Don't want to deal with it. But let's take a look about what actually happens. Okay, so we have over here, so we know the shares that are held on a cumulative basis. So for example, we know that what we were able to buy, and actually this weekly amount was at 10. I had us looking at a bigger amounts. So we're gonna put those back to auto. Wonderful. Okay, so we've got back to our $100 a week, and we're gonna say that in that first week we're able to get our 2.85, and then we're 2.91, but now added together, that's 5.77 shares. So by week 2, that's what we have. And then we can see as we continue to add to our shares, we get down here, eventually we have up to 100 shares, and we end with 750 shares of the stock that we're buying into. And we can see what the market value is, because we know at each given week, we know the total number of shares that we hold, and we know the stock price. So we simply multiply them together. We can figure out the market value of the equities that we own. And we can get our total investment in terms of every single week. We're just incrementing $100 a week. So this is what would be sitting in your checking account. Okay. If you were not going to invest in the stock, this is what you would have if you invested. And you can see that initially, and this is the red ink we're talking about, and this is the uncertainty or the scary part about investing for a lot of people, is that in this example, initially, you are much better off having your money in the checking account, okay? So you're halfway through the year. In fact, let's even kind of go down. I think you finish, your first year of investing. And let's say you were talking to your friends about, hey, I'm putting some money in the market and I'm sticking with it and everything else. And they say, oh, really? You're sticking with it, How's that going for you? And you say, well, at the end of the year, my $100 a week is turned into a little over $4,000. And they say, well, that's great, but, my little safe checking account's got $5,200, and they're laughing at you. They think that you're an idiot, okay? But what happens is, okay, our $100 a week, we're able to buy at these, teenage prices over here. So when it's down, as low as $15, we're able to buy a lot more shares than back when it was up at $35, which is the beauty of dollar cost averaging. So when the stock goes lower, you stick to that same dollar amount, you're going to be able to buy a lot more shares. So what that does is that means that when the stock actually does recover a little bit and gets back up to about $26 or a little over $26, when that happens, we all of a sudden have a situation where our total stock investment is worth over $20,000. People sitting with their checking account are sitting at $15,500, which investing $100 a week, come on, that's nothing to sneeze at. That's still good, but certainly you can see that after 3 years, you would be surpassing your friends who are very safe and cautious people. So this is what that looks like graphically. We can see the difference between your total investment, so what they would have in their checking account, and you can see the market value of your shares from this example we've been walking through. So, the orange line is going to be the total investment, and that's just going to be that straight line because it's $100 every single week. And the market value of the shares is going to show that, you're going to see in that drop period, there's going to be a very big gap there and a negative gap. Now, after you get to about the 90th week of investing, which again, I understand that in real time, to say that it takes 90 weeks to catch up in this example, it's certainly not a trivial amount of time, but after your 90th week, you are even with the person with the checking account. And by the end of your 3 years, again, you are now thousands of dollars better off from investing and not taking the cautious approach. So again, the whole point of this is to say, if there's a company you want to invest in, there's something you really like, let's say you're investing in Amazon and you're like, hey, I think Amazon is going to continue to do really well over the next, 3, 4, 5, 15 years, whatever your horizon. I like Amazon. I like Netflix, whatever those cases are. You like DraftKings. I think that there's a really solid argument to make that says, take the cautious path in terms of being able to put a set amount or average yourself into the stock. And in this example, it really shows you that if you take that approach, that even if you start facing a decline in the value, okay, so you watch the stock go down because maybe it truly was overvalued, but you didn't know the timing. So you watch the stock go down, that you can still be better off than if you were just putting this into a checking account. So this video is really meant to just kind of help any new investors get over their fear, to show you that, hey, that like in the long run path, even with declining stocks, you can still get a path to profitability. So yeah, hopefully this example was useful. But if you have any questions about the methodology, you challenge this, you think I'm crazy, you think you should be spending hours and hours diving into the exact valuation every single week for every stock that you own, let me know. I'd love to know what you guys do, what you guys think, and what you thought of this example. All right. Well, thank you for those who stuck with that analysis. It was great to walk you through that example. And this video is, again, really meant to show you that you don't need to get the timing right if you have, a stock idea, that if you're going to, average in over time, you're going to diversify across time, that you're really setting yourself up to kind of be more protected than just kind of throwing money in at one set point in time. So yeah, like I said, thanks a lot for watching this video. Questions, comments, or anything you want to see in the future, go ahead and drop a comment below, and appreciate you checking it out.